Yesterday, the Bank of England raised the interest rates in order to help counteract inflation. A common question I've been receiving from clients is, why? How does this help with inflation? What's the problem? Why isn't it working? Now, I'm not an economist, I'm an independent financial advisor, so what I'm going to tell you now is a simplified explanation to try and make things make sense for you. And at the end of the video, I'll talk about what you can do in your personal finances to try and help you weather this storm. The whole purpose of raising interest rates is to try and control inflation. Now, inflation is the rate at which the cost of everything is rising, essentially. By raising interest rates, the Bank of England hopes to slow down the economy by making consumers and businesses spend less money, hold on to it, thereby lowering demand for products and services, which therefore will help to bring their prices down. Because if demand is low and supply is high, prices come down. If demand is high and supply is low, prices go up. That's just how things work. Raising interest rates is supposed to have a two-pronged effect. It's supposed to be a carrot and there's supposed to be a stick. The carrot is supposed to be that by raising interest rates, it becomes desirable to save because banks and building society should stop paying higher levels of interest on your money that they are holding on to. And at the same time, the stick punishes borrowers, makes it more expensive, discourages people from borrowing money, spending money they haven't got. So simultaneously, by encouraging people to save and by encouraging people not to borrow as much, they try to squeeze people's personal finances so that you buy less, you do less, and therefore that brings down demand in the economy while supply remains the same, which therefore brings down prices, which slows down inflation. Why isn't this working? Why are they coming to continually raise interest rates? The problem, in my opinion, is that the carrot isn't happening. When they raise interest rates, the amount the bank's paying you on your savings should go up and the amount they're charging you on your debt should go up. The gap in the middle should stay roughly consistent, so banks' profits shouldn't really increase. However, this is not what's happening. The rate rises are being passed on quickly to borrowers and they're not being passed on quickly to savers. So the bank's margins are increasing, they're making more money. So it's penalising borrowers, waving that stick, but it's not rewarding savers, waving that carrot. Now, what can the government do? Well, in an ideal world, they would get the banks to raise the price that they're paying on your savings. And that would help to encourage things to go both ways, the carrot and the stick. But obviously they can't force things. It's not like they own a bank that they can launch a product. The introduction of something like tracker mortgages that already exists, but tracker savings that follow the Bank of England rate might help to do this sort of thing. But they don't exist and there seems to be very little competition in that space. That's what the government need to address, in my personal opinion. It's been in the news today that the Chancellor is going to visit with the Prime Minister today and with mortgage lenders, and they're going to discuss ways in which they can help borrowers. A lot of people are seen to be calling for some sort of support in the way that they supported energy bills earlier in the year, last year, when they were giving a fixed payment to people to help them with their bills. Now, doing that actually made inflation worse because people didn't feel that squeeze as much as they would have done because they were given some extra money to help cope with that. So the calls for them to give payments to people with mortgages to help make things easier. If they do that, in my opinion, that is for no other reason than to raise votes. It's not going to help the economy. It's not going to help to cause the squeeze that needs to be done in order to bring down inflation. What can they do? There are things that they can do to help borrowers. They can do things like they can place a ban on repossessions so that even if things do go wrong for people who overstretch themselves, at least they're not going to end up homeless. And they can place that for some sort of time, but we'll have to wait and see what they do. What's important to you is how you manage your personal finances. The economy is the government's problem, your household is your problem. So what can you do? The government is calling for employers not to give wage rises or not to give excessive wage rises because the more people's wages increase, the more they have to spend, the less they feel the squeeze, the harder it is to cool down demand in the system. Now, if you're offered a pay rise, don't refuse it. You're responsible for your house. The government's responsible for the economy, not your problem. Now, for most people, mortgages are the big worry. If you're coming to the end of your mortgage deal, you've probably been on a very low rate and you're looking at a much higher rate. Now, as independent financial advisors, with a mortgage broker in-house, we would strongly suggest that you speak to a mortgage advisor. And I'll put a link down below so you can have a quick chat with ours if you want to, like 15 minutes on the phone or something, just to see if she can help you. Now, essentially, there are things you can do when it comes to restructuring your mortgage when it comes up. First of all, don't automatically take the next best deal that your bank is offering you. Shop around. The other providers will be offering other deals and they may be better for you. If you're finding that it is becoming unaffordable because of the increase in rates, obviously you can consider selling and look at the downside, but also you could consider things like increasing the term of your mortgage. Now, it's going to cost you more money to put your mortgage up for a longer term, but it'll bring the payments down for now. And in the future, if rates come back down, when you redo your mortgage again, you can shrink that term back down and try and catch things back up. You've heard a lot of people talking about going and doing interest-only mortgages. That's generally not a great idea because you're not paying off anything you owe. And if property prices fall, you could find yourself in negative equity unintentionally, and that's a trap you do not want to end up in. The big question at the minute is, with rates being high, should I fix? Or should I go variable rate and hope that rates are going to come down? Now, this is crystal ball stuff. Nobody knows. But a good mortgage broker can help you in considering things that you may not have thought of. So, for example, fixed rates are generally 2, 3 and 5 years. If you think rates are going to come down in the future and you don't lock yourself into a 5-year fix, then great, consider a 2. Now, if you think rates are going to come down really quickly and you want to get out of that fixed rate, yeah, you can go for a variable rate, but that runs the risk, and if rates continue to rise, so does your bill. Now, a fixed rate, although it might be a 2-year fixed rate, you don't have to stick with it. If you get halfway through the fixed rate and rates have tumbled dramatically, so much so that you're paying well over the odds, then you can usually pay a penalty to get out of it and switch to a new deal with somebody else. You do the maths at the time, your mortgage broker will, on whether it is actually worth it, whether you recover on the new deal the amount that you'll pay in penalty. So when you're looking at your new mortgage deal, something to ask your broker to consider, although a good one will be considered this anyways, if 2 deals are virtually the same, which one has the lower penalties? We're going through unstable times at the moment, so having the ability to get out of a deal at a lower cost may be a valuable asset for you. If it's only costing you an extra £1 or something a month in order to be able to do that, then it seems like a no-brainer to me to keep your options open. But anyway, choosing the right deal for you is a personal thing, and you should definitely speak to a mortgage broker. A good independent advisor can really help you in this situation to make sure you know you're making the best moves possible. And if you are in real trouble, then they should be able to refer you to some sort of charity or organisation that can give you some sort of support with restructuring things in the best way possible for you. If you have any questions, feel free to comment down below and I'll get back to you if I can. But again, there is a link below that if you want to speak to our mortgage advisor, you can book in a 15-minute telephone call or video chat just to see roughly whether she can or can't help you. All right, take care. Bye.